At the end of the day, I like to think that maybe President Trump would start by trying to initiate dialogue before going to maximum pressure, because delivering on a campaign promise like lower gasoline prices through a looser global balance is obviously a desirable objective for him. Personally, if he went for maximum pressure, and even if there was some effectiveness in terms of taking out Iranian barrels from the market, who says that Saudi Arabia or any other OPEC country who has spare capacity is going to be there to plug the gap? Hello and welcome to our 14th episode of Oil Insights. I'm your host, Harry Tchilinguirian, Group Head of Research here at Onyx Capital Group, and I'm joined today by Onyx Research Associate Martha Dowding. Hi, Martha. Before we start the show, please like and subscribe to the podcast. I invite you to also visit Onyx's LinkedIn and YouTube channels for more interesting and exciting content. It has been nearly 2 weeks since Donald J. Trump became President-elect of the United States, and he has been actively filling cabinet positions to hit the road running when he takes office in January. Elections have consequences, President Barack Obama reportedly told Republican members of Congress after his inauguration in 2009. Well, looking at the different asset classes since the election, we have seen pronounced movements in equity markets, gold, yields, the dollar, and cryptocurrencies. However, price action in oil has been, in comparison, remarkably uneventful. Since the elections, oil has shifted lower to trade in a narrow range, although up yesterday as it saw some support from the outage of a large North Sea field, that for an indeterminate amount of time, but nonetheless, it seems to us that the overall mood is still one of consolidation. The question really, how long until we have a breakout, and what catalyst will provide that spark to set off the next rally or the next correction? At the time of this recording, front-month Brent was just trading above $73 per barrel. So in this episode, we're going to try to examine why oil has been relatively unreactive compared to other asset classes, and see if the technical signals give us any clue about the potential direction of oil prices, at least in the very short term. As usual, we're going to kick off the show by looking at positioning in the market by risk takers and the commitment of traders data that runs to last Tuesday. So the data will incorporate the reaction of market participants to Donald Trump's election on November the 5th. So Martha, can you start us off and take us through the positioning and how that positioning has evolved on Brent? What can we say about it?
So for the week to the 12th of November, which is the first week to kind of capture the impact of the election, we saw that the speculative funds were technically risk on and bearish net, but the speculative position changes were pretty underwhelming and matched the kind of underwhelming price action that we had seen in the week two. So in terms of just the numbers, there was a 17 million barrel addition of length, which is about 8.5% of the total, and around a 31.4 addition of short positions, which is about 36.5%. This felt to be a more significant percentage move than we've seen in the past month or two. We've seen a removal of this percentage amount of positions a few weeks ago. It's unremarkable, I would say, in a word.
Unremarkable, like the price action.
Yeah.
So I'm gathering in terms of net positioning, well, basically nothing's happening. So that would essentially say that the long-short positioning ratio that we typically follow in order to get a gauge of whether or not we're going to get a rally, that hasn't changed much either.
The managed by money long to short ratio has dropped a bit from about 2.33 to 1 in the week prior to about 1.85 to 1 now. Putting that in perspective of like history, we can see that this is a move from about the 15th percentile from all weeks since 2013 to just shy of the 10th percentile. And this shows how unusual the market positioning is currently and how bearish the market is as well, because it shows that the huge moves in the other risk assets, the market is already quite short. This just isn't happening for oil at all.
So, as usual, we tend to compare the commitment of traders data with Onyx's own proprietary measure of where the CTAs are at. And are we finding the same sort of, I guess, uneventfulness, for lack of a better word, in terms of the weekly positionings?
Yeah, so we saw the net positioning of the combined futures that we look at on the CTA, which will be labeled on the graph. We saw that actually move up initially from just from under 100,000 lots at the start of November to around minus 60,000 lots on the 8th of November, and then it fall back again to lower than 100,000 lots on the 14th of November. So, gain loss net very, very little again in the combined futures. So looking at the different products and the crudes.
It almost feels like we're waiting for Godot here. When we look at the positioning of risk takers, whether expressed through the commitment of traders data or even our own measures, I mean, clearly the market is hesitant to take a stand one way or the other. It's just really uncommitted. And I guess, as I was indicating a little bit earlier, we're looking for a catalyst. And what that catalyst could be, well, still needs to be determined. We would have thought that with elections, we would have something. And I think we're going to be turning a little bit and looking at what's been happening in terms of other asset classes and in terms of oil. So the following chart that you're going to get on the screen is going to show you the relative evolution of the dollar, the S&P 500, the front-month Brent contract, all normalized to the 5th of November. And so what we've seen is some progression in equities, a firmer dollar, higher yields, cryptocurrencies that just basically rocketed, and oil that is, as I was indicating in the intro of this podcast, decided to decline, albeit modestly, but bucking the trend of the other asset classes. So let's start off with some top line views on what these other asset classes were doing. So what's your take in terms of why equities were moving higher? If we were to think about this in the context of, we had an election, we had policy proposals from Donald Trump, he got elected, and therefore we were waiting for one of these policy proposals to be a catalyst for either one of these asset markets. So for equities, what basically drove the move?
So starting with the equities, I think that the most important proposed policy here has to be the tax reduction. So this would increase the company's net earnings, which could impact the dividend distribution policy. And then aside from this, there's the broader implications of the tax reductions to the economy as a whole, which could just boost the economy and be positive for revenue growth as a whole. So from the perspective of future cash flows discounted to the present day, stock valuations could be perceived as moving higher, and we've kind of seen that built into prices now.
Yeah. So basically companies with more cash on hand, and that's a big headline driver. So if we turn to the dollar and yields, obviously these have moved higher and there's a clear linkage between the two. How do you see the driver there? How do they react to in terms of policy proposals?
So for the US dollar and the yields, the latter is driving the former. And I think this is for a combination of both the lower taxes just said and also the tariffs, which have been a massive part of the campaign rhetoric. So firstly, the lower taxes could lead to a deteriorating fiscal position and also higher debt issuance, which could put upwards pressure on the yields and the dollar. So that's kind of being built in now. And lastly, to the tariffs. So this is kind of depending on how high they're going to be, which they've been said to be different things, and we will have to kind of wait there, but which will see how much of this will be passed on to the companies from the companies to the consumers, the end users, and that will impact, of course, inflation and the yields as well.
Mm-hmm. Yeah, no, I mean, certainly in this case, it's all about inflation expectations, right? Inflation expectations and debt burden. So it's kind of interesting. The two core principles in terms of policy proposals are there really driving both equities and dollar. And I guess finally an interesting one is cryptocurrencies. And so I think you read up a little bit about this, a bit more than I have in terms of the multiple promises that Trump has made during his campaign. But it seems that there's a heavy regulatory aspect in terms of cryptocurrencies in this story.
So as with tariffs, I think this is something that's been a real rhetoric in the campaign trail, and lots of the kind of MAGA fans have been kind of looking to this deregulation of the industry. And there's also been kind of talks of maybe like a stockpile of US Bitcoin as well for the state to own. But there are questions about the feasibility of kind of everything here and how much they're going to kind of put into play this. But deregulation for Bitcoin and the whole market is definitely on the top of their priority list.
Well, I mean, it's certainly clear that at least for a number of asset classes, there was a clear implication that was drawn out from the get-go as soon as Trump was declared actually president-elect. These assets moved fairly quickly. Now, what I would say is like when we start thinking about oil, things are going to be a little bit different, right? The question is there anything really that the oil market has extracted from what President Trump has said during his campaign? So perhaps we could start with, domestic issues. Is there anything we could glean from the campaign promises that would have an impact on domestic oil in the U.S., and how will we see that in terms of price implications?
Yeah, so the theme of deregulation is kind of brought up again sometimes in oil as well, but I don't think this is going to necessarily translate in such a one-to-one way in like a booming surge in oil production any more than it already is. It's going to help production, but I think this needs to be kind of caveated with a lot of further things too. So the shale industry is not the same as it was in 2010 or when Trump was also kind of running previously and we had the drill baby drill rhetoric, which they are still saying again now when the industry is transformed. The capital discipline of the companies in the basin is what's driving the decisions there. So we could expect any capex orientated at expanding the production to lean on the conservative side. The days of drill baby drill are behind us here, as I've said. The loosening regulations in terms of drilling on federal land is something they do kind of have that to use, and also on the offshore, which there have been kind of changes to with the Inflation Reduction Act. So from a US supply perspective, there could be some bearish moves, but I think there's a lot to kind of work through there in terms of getting that deregulation through.
So I think it's not a clear-cut bearish signal
No.
in terms of what we could pull from this, because at the end of the day, as shale continues to contribute the bulk of U.S. supply growth, we're looking, as you're saying, and I think that is the key point, capital discipline as driving decisions. So of course, easier permitting, faster approval, opening of federal land, offshore licensing, all these things matter, and they could certainly help in terms of supporting U.S. supply growth. But I think really it's that decision-making process that has certainly changed, and as you're indicating, more conservativeness on the capex side. So I mean that's for domestic policy. So let's say slight bearish implication off of that. Can we turn now to like foreign policy? And I think in terms of foreign policy, I mean there are two real aspects to it. There's one that's sort of the geopolitical component, and whether foreign policy under Trump is going to help deflate geopolitical premia or inflate them, as the case may be. And on the other is sort of direct implications of foreign policy on oil supply. And I think to that we could also add, a third aspect, which is going to be the sort of foreign policy as expressed through commercial policy, and that is coming back to the tariffs that you were discussing a little earlier. So I think if we start off with foreign policy and looking at basically what can we say, in terms of at least on the diplomatic side, right?
So starting with the geopolitical risk, I think the two main elements there have to be Russia and also Middle East that have kind of been driving narrative and the market this year especially. It's too early to tell if Trump really has that, I say diplomatic edge, that Trump-style diplomacy, diplomatic edge that would normalize the relationships with Russia, leading to some form of solution in the Ukraine, bringing together the parties to some kind of agreement. It's too early for that. But if he is successful, we could see some more normalized relationships with Russia, and then we would have to kind of discount and see the impact of kind of the resume of flows from Russia. Would we see that again? How's Europe, moved away from that a little, but no. So that would be interesting to see if that's possible. Looking to the Middle East, it will be interesting to see if Trump can bring together the stakeholders and the different countries here into some kind of Abraham's Accord, that we did previously in his last term. If successful, that could have a really significant bearish impact on the oil prices.
I like the expression diplomatic edge because certainly with President Trump's relations with Saudi Arabia, Russia. I think even the Iranians have hinted recently that they're willing to talk with President Trump. So it's difficult in terms from the diplomatic sense. But if we do get some kind of a peace dialogue, at least that, maybe that could help in terms of how much geopolitical risk we see in the prices. Now, again, turning to the Middle East, and this is perhaps the issue when it comes to, is there a clear line that we could draw from Trump's foreign policy proposals to oil supply when it comes to Iran, right? I think that's an interesting question because the first one, appeasement, kind of bearish for prices. Now we're turning to something that a lot of people are considering, bullish. And well, what do you think about maximum pressure on Iran?
I think this is a lot less clear in the rhetoric than he's been saying for the risk premium. We hate war. That's been kind of the motto that we've been seeing. I think applying maximum pressure to Iran, like we saw in 2019, we saw that 1 million barrels a day leave the market, dropping from the exports. And I don't think it's as clear cut as this could be. So Israel favored a Trump presidency, and Israel favors that maximum pressure agenda to weaken Iran and the proxies. And I think looking aside from Trump is important here at his proposed cabinet. The cabinet appointments by President-elect Trump, like Mike Waltz as the security advisor and Marco Rubio at state, suggest a pretty hawkish policy, being pretty hardline on Iran.
Yeah. But as I said, just to be a little bit controversial here, now, does it make sense to apply maximum pressure on Iran? Because it's one of those things where when you actually consider that Iranian oil is basically almost exclusively flowing to China, it's carried there by a dark fleet, the effectiveness of such a policy, well, in terms of the previous instance of imposition of, like say, maximum pressure, that effectiveness is going to be clearly reduced. It also kind of involves having China being on board. So when we were talking about tariffs a little bit earlier, I think that impending tariffs on China are something that could make the Chinese less than cooperative in this kind of situation. So another thing that, I was just saying a little bit controversial, but what do you think about trying to keep the global oil balance loose this year?
I think especially with one of the campaign promises being about gasoline and kind of reducing price at the pump, it's already fairly low. And him coming out and doing such an outward thing that could be seen as, bullish oil could be not something that he really wants to be seen as doing.
Yeah, I tend to agree because it's not, obviously this is not the sort of consensus point of view when it comes to the approach. And I mean, yes, there are Iran hawks in the cabinet, and you mentioned them. There are more. We're not just limited to these two. But at the end of the day, I like to think that maybe President Trump would start by trying to initiate dialogue before going to maximum pressure, because delivering on a campaign promise like lower gasoline prices through a looser global balance is obviously a desirable objective for him. Personally, if he went for maximum pressure, and even if there was some effectiveness in terms of taking out Iranian barrels from the market, who says that Saudi Arabia or any other OPEC country who has spare capacity is going to be there to plug the gap? And that brings us back to some of that diplomatic edge that we were talking about. We can't be too sure past relations will always be the same as ones that Donald will have to be facing in the future. Finally, I guess, policy proposals, we talked about, commercial proposals also being an extension of foreign policy. And in this case, tariffs.
Yeah, I think the main point about tariffs is that it's so up in the air as to what will actually be done to what country and to what extent. I think there's lots of posturing down the campaign trail, and there's lots of rhetoric of this like big bad tariff against China. But I think at the end of the day that if these tariffs come into play, they'll impact the global economy poorly and therefore impact oil demand poorly.
Yeah. No, I mean, the IMF has certainly warned about severe economic consequences in a full-out trade war. It is something interesting is you mentioned posturing. So that kind of brings us a little bit into a game theoretical framework, where you're trying to obviously leverage a position, and you want to be negotiating from a position of strength. So you come out outright and say, I'm going to impose 60% tariffs on China, maybe 10 to 20% on everybody else. Again, between what is said and what is going to be done, there could be a gap. So if we go down, let's say, the severe tariff route, then obviously we are faced with economic consequences that can't be ignored. And so when we look at the forecasts we've seen recently by the major agency forecasters, such as the IEA, OPEC, the US Energy Information Administration, their numbers do not incorporate yet a tariff on economy risk. So it will be really interesting to see what happens there. But effectively, if we're going to be drawing conclusions from everything we said between diplomacy on geopolitical risk, between maybe choosing a different route, threading a different needle with Iran when it comes to sanctions, tariffs, and the economy, all these things are still sort of leaning on the bearish side, right?
Yeah, definitely. Yeah, so I think the conclusion of most of all of those was that it's important to keep an eye out on that downside risk, as looking at demand as well as increasing the potential increases to supply.
So interestingly enough, we are converging, which is a question, or the title of this show is Trump bearish for oil? And we're kind of going down that path, and the fact that the oil market has not like reacted violently to the upside, well, may indicate that they could be or not onboarding some of these themes in the way that they're pricing the crude. So of course, having said all of these things, we like to have our crystal ball moment. So if you had to make a wild guess now at where Brent would be at the end of the year, so just before the January inauguration of President-elect Trump, where do you think would be? So we're trading today slightly, at least on the front month, just above $73. I think $73.30 and somewhere around that at the time of this podcast. Would you venture a guess as to being above a certain level or below a certain level?
I think at the end of December, at the end of the year, not pre inauguration, there may be other drivers, but at the end of the year, it'll be interesting to see the risk appetite of traders in the less liquid contracts softening, less busy market because of the holiday season. I think that if we do break below 70, this becomes like a good value zone and we see this really strong buying again. So I think that although I do believe we are going to go below 70, this won't be sustained and we may, gap up a little in the liquidity and we'll end up, I wish I could give a wild guess like you said, but it's not wild, it's around 70.
So keeping her at the 70 mark.
Yeah.
I mean, personally, again, because we're inferring things, obviously we have inferred things from policy and it is a point of view. Other people, just by simply changing one hypothesis on Iran, for example, and maximum pressure could have a very different view. And so I would be thinking that, if OPEC maintains its cuts in the face of obviously weak demand growth this year, weak demand growth projected for next year, if it keeps it cut, then we should be able to hold roughly around that level. And then by the time we get to January, it may be a whole different ballgame because he will be in office. But so all these things are sort of overarching narratives. I think what would be interesting is to actually look at basically technical indicators. So we haven't done this before on the show, but I think it's a good opportunity to start having a glance at these to see if they're telling us at least something for the short term. Is there anything we could infer from sort of the usual toolkit that technical analysts have when it comes to gauging price direction?
Yeah, of course. So looking at the most long-term thing we can see on this chart that we have on the screen, we can see that there has been, even prior to Donald Trump's re-election, Brent has been kind of in this downwards channel since early April, which is so long.
Seems really long ago, yeah.
We are currently in the middle of the channel, so we're holding above the support level of around $71.40 per barrel, which has been established between March and August. We've come above that, and now we're kind of coming down to closer to that support level again. And then looking at the short and longer term moving averages and seeing how these interact with each other, looking at a 10-day moving average for a short, one and a 50-day moving average for the longer term. We can see that these are acting kind of as weak resistances. The price action since early September is developing a continuation pattern with an emergence of more or less kind of a symmetrical triangle here. And so for now, the support trend lines of the triangle are kind of dovetailing with the lower Bollinger Band line, which has seen some, which is kind of helping the upwards price reversals that we've seen, I think, especially yesterday, you mentioned in the introduction.
Yeah, so we have like two technical supports there to keep the price up at least for now. But otherwise in this triangle.
Yeah, so I think then turning to look at the momentum of the market, or kind of lack thereof, the momentum indicators don't show any strong direction really to help move past this support or resistance trend lines. The RSI is essentially in the middle. It's in complete neutral territory, and the momentum captured by the MACD chart shows a slight divergence from the signal line, but we can see the histogram is very small, it's modest negatives. And then lastly, looking on the smaller scale, we can see on a candle perspective, there is a bullish engulfing pattern from yesterday on the 17th. But as we mentioned in the introduction, this is probably driven by the outage of the Johan Sverdrup field in the sea. But this is 2/3 of production is back online now.
Yeah,
Everything's being scaled
that's
up.
when they announced it, yeah.
Yeah, so I think this is being essentially discounted, and we've seen that resistance point come into action, and prices, it's not carrying on today, the kind of support from this.
Okay, so I mean, basically in this interesting downwards channel, so now in terms of price action, are we there yet for a breakout, or do we need to wait a little bit longer? What would you look out for before calling the breakout?
I think just to look for further consolidation, narrowing of the bands, and looking at the volatility day on day of the price action, we see if we're expecting the price action to move within the triangle, that would mean volatility dropping as well. So yeah, keeping an eye on those Bollinger Bands and the volatility ahead of a breakout possibly.
Yeah, I think that, I mean, certainly when it comes to looking at these things, of course, they're there as part of the toolkit. I mean, for me, if we're to sort of step back and go back to the macro picture, this downward trending channel that we've been in, where basically the cap has been pressured downwards as a result of poor macroeconomic realities centered on China. The support may be lessened as a result of lesser effectiveness of OPEC cuts, or their current level of cuts in relation to the general environment. And then we've been moving up and down within this downward channel on changes in perception around geopolitical tensions, maybe the dollar, other events. I think the interesting thing is that if we do come to consolidate, and as you indicated, if the volatility starts leveling off or coming down, we get these Bollinger Bands beginning to narrow. That typically is a precursor for a breakout.
And
right?
They're already narrower than we have seen earlier this month and earlier in the year as well, which is important to note when thinking about that.
So possibly an imminent breakout. Well, again, at the end of the day, which way the breakout is going to go, I don't know. But if you do believe in a breakout, then this is possibly an opportune time to be looking at option strategies with strangles. So buying out of the money calls or buying out of the money puts in view of an imminent change. Now, the interesting thing, of course, as I've been mentioning, Donald Trump is not yet in office, but it doesn't preclude him from tweeting. And so
truth socialing.
And truth socialing. So, but now that Elon is his best friend and spends a lot of time in Mar-a-Lago, then we could, expect that he uses the X platform to communicate. And I wouldn't be surprised personally that once his cabinet picks are complete, that you do see some front running ahead of actually the inauguration. So in the interesting time for oil, because exposure is low, as we saw at the beginning, right? We have consolidation in the market, bearish consolidation, because at least some of the implications of policy during the campaign are bearish. But at the same time, we don't know if they're going to be implemented in the way that we think. So perhaps ahead of an impending breakout, that is the best strategy. Go along those strangles, And either way the price goes, then those tend to be profitable on those occasions. So with that, we come to the end of the show. As usual, please like and subscribe to the channel, and we'll see you next time. Thank you very much, Martha.
Thank you.